I don't traffic in conspiracy theories. I don't make sensational claims about hidden fraud. And I certainly don't throw around accusations of $100 billion accounting scandals without evidence. That's not how I operate. That's not how serious investors should think. And anyone claiming there's some massive fraud that nobody is talking about is either trying to sell you something or doesn't understand accounting. But let me tell you what I do see, what I have been seeing for years, what troubles me deeply about modern corporate accounting and financial reporting, because there are real problems, serious problems, problems that distort understanding of business value, problems that mislead investors, problems that create bubbles and misallocations of capital. These aren't secret conspiracies. They're hiding in plain sight. In financial statements, everyone can read, but most people don't understand. I'm going to walk you through what I consider the biggest accounting problem in modern markets. Not fraud in the criminal sense, not executives cooking books or hiding losses, but systemic distortion, structural problems with how companies report earnings and how investors interpret those reports, problems that create $100 billion or more of phantom value, problems that nobody wants to talk about because acknowledging them would require admitting that much of what we think we know about corporate profitability is misleading. This isn't going to be exciting. It's not going to involve dramatic revelations or hidden scandals. It's going to be about boring accounting rules, about how compensation gets reported, about how acquisitions get treated, about how intangible assets get valued, about the gap between reported earnings and actual economic reality. These topics put people to sleep, but understanding them is crucial, because if you're investing based on reported earnings without understanding these distortions, you're making decisions with bad information. Let me start with the single biggest accounting distortion in modern markets: stock-based compensation. Companies pay employees with stock options and restricted stock units. This compensation is real. It has real value. It costs shareholders real money. But the way it gets reported in financial statements systematically understates its true cost. And the cumulative effect across all public companies amounts to well over $100 billion annually of understated compensation expense. Here's how it works. When a company grants stock options or RSUs to employees, accounting rules require them to expense the value of those grants. This seems straightforward, but the execution is problematic. For stock options, companies use pricing models to estimate value. Black-Scholes or similar models, these models make assumptions about volatility, interest rates, and exercise behavior. The assumptions systematically understate the real cost to shareholders. Why? Because the models assume rational exercise behavior. They assume employees will hold options until near expiration. They assume efficient markets. But reality is different. Employees exercise options early for various reasons. This early exercise means the options are worth more to employees than the model suggests. The company reports lower compensation expense than the true economic cost. For restricted stock units, the accounting is even more problematic. Companies grant RSUs that vest over time. The accounting expense is based on the stock price when granted. But here's the trick. That accounting expense doesn't represent actual cash flowing out of the company. It's a non-cash charge. So companies report it as an expense, but then they turn around and add it back when calculating adjusted earnings or free cash flow. They claim it's not a real expense because no cash changed hands. This is nonsense. Stock-based compensation is absolutely a real expense. When a company grants stock to employees, existing shareholders get diluted. Their ownership percentage decreases. The company could have sold that stock to investors and received cash. Instead, they gave it to employees. That's a real cost, a real expense. The fact that it's non-cash doesn't make it any less real. Let me give you a concrete example. Take a large technology company. They might report net income of $20 billion. Sounds impressive. But buried in the footnotes, you'll find they granted $15 billion worth of stock compensation during the year. The accounting expense for that compensation might only be $10 billion because of how the valuation models work and how grants vest over time. And then when they report adjusted earnings or free cash flow, they add back that entire $10 billion. They're telling investors to ignore a massive real expense. What's the actual economic reality? The company earned $20 billion, but they gave away $15 billion worth of stock to employees. The economic earnings available to existing shareholders is really only $5 billion, not $20 billion. The difference between reported earnings and economic reality is 300%. And investors who don't understand this are dramatically overvaluing the business. This problem is pervasive, particularly in technology, but increasingly across all industries. Companies have shifted from cash compensation to stock compensation. Why? Because it makes reported earnings look better. Because analysts and investors focus on adjusted earnings that exclude stock compensation. Because it pushes the real cost off into the future through dilution, rather than showing it clearly as expense today. The cumulative effect is staggering. If you go through the financial statements of major public companies and properly account for stock-based compensation, if you treat it as the real expense it is rather than adjusting it away, reported corporate profits would be drastically lower. Tens of billions just among technology companies, over $100 billion across the entire market. This isn't hidden. It's all disclosed in footnotes, but nobody wants to acknowledge it because doing so would require admitting that valuations based on adjusted earnings are built on fantasy. I've been vocal about this for years. When I evaluate businesses, I always fully expense stock-based compensation. I never use adjusted earnings that add it back. I treat dilution as a real cost. This approach dramatically changes valuations, particularly for technology companies, where stock compensation is enormous. And it explains why I've avoided many of the high-flying tech stocks that other investors love. Not because I don't understand technology, but because I understand accounting. And the accounting tells me the real economics are far worse than reported earnings suggest. Now let me talk about the second major accounting distortion: goodwill and intangible assets from acquisitions. When companies buy other companies, they often pay far more than the book value of identifiable assets. This excess gets recorded as goodwill and intangible assets. Under current accounting rules, these assets don't get amortized like they used to. They just sit on the balance sheet. Companies are supposed to test them for impairment periodically, but impairment testing is subjective. Companies have enormous discretion, and surprise, they rarely find impairments until it's undeniable. This creates systematic overstatement of assets and earnings. Companies make acquisitions, often at inflated prices. They put huge amounts of goodwill on the balance sheet. That goodwill represents the overpayment, the amount by which acquisition price exceeded real value. But instead of systematically writing it off through amortization, which would hit earnings, it just sits there, quietly inflating asset values, making returns on equity look better than reality. Let me give you the economic reality. When you pay $100 billion for a company worth $60 billion, you've destroyed $40 billion of value. That $40 billion should be expensed over some reasonable period. It should hit earnings. It should reduce reported profitability, because that's the economic reality. You overpaid, you destroyed value. Shareholders should see that destruction clearly, but accounting rules don't work that way anymore. The $40 billion goes on the balance sheet as goodwill. It sits there indefinitely. The company reports earnings as if the acquisition created value when it actually destroyed value. And investors looking at financial statements see inflated assets and overstated returns. They don't see the value destruction clearly until years later, when impairment charges finally come. And by then, the executives who made the acquisition have moved on. They got their bonuses based on reported earnings that ignored the reality of value destruction. The cumulative effect, again, is enormous. Corporate balance sheets are loaded with goodwill and intangible assets from decades of acquisitions. Much of it represents overpayments that should have been written off but haven't been. These inflated assets make returns on equity look better, make companies look more profitable than they are, create a systematic bias toward overstating corporate value. I've always been skeptical of acquisitions. Most destroy value. Most involve overpayment. The accounting rules that allowed goodwill to avoid amortization made this problem worse. They made acquisitions look less expensive than they really are. They made serial acquirers look more profitable than economic reality justified. And they've contributed to waves of acquisition activity that destroyed enormous shareholder value while enriching the investment bankers and executives who promoted them. The third major distortion is revenue recognition for subscription and software businesses. Modern accounting allows companies to recognize revenue in ways that dramatically overstate near-term profitability. Companies with subscription models book revenue upfront even though they have to deliver service over years. Software companies recognize license revenue immediately even though they have ongoing obligations. Cloud companies report revenue in ways that obscure the real unit economics. The problem is timing. Traditional businesses recognize revenue when they delivered value. You made a product, sold it, delivered it, recognized revenue. Simple, clear, matched to economic reality. But modern revenue recognition rules allow companies to front-load revenue to recognize it before they've actually delivered corresponding value. This makes growth look faster than it really is, makes profitability appear sooner than it actually arrives, creates distortions that mislead investors about business quality. I'll give you an example. A software company sells a 3-year license for $3 million. Under revenue recognition rules, they might recognize substantial revenue up front, maybe half or more in the first year, but economically, they're committing to provide service and updates for 3 years. They have real costs over that entire period. The true economic profit emerges over 3 years, but the accounting front loads revenue and profit into year 1. The company looks more profitable than economic reality. Investors overvalue it, and when growth inevitably slows because you can only front load so much, everyone acts surprised. This problem is rampant in software, cloud services, and subscription businesses. Companies book revenue aggressively. Investors celebrate high growth. Stock prices soar. But the underlying unit economics are far worse than reported numbers suggest. The profit margins are overstated. The growth is partially optical. And when you properly match revenue to the economic reality of service delivery, many of these high-flying businesses are far less attractive. The fourth distortion is in how companies report free cash flow. Free cash flow has become the holy grail metric. Investors love it because they think it represents real cash available to shareholders. But companies have figured out how to manipulate the calculation. They exclude things that absolutely should be included. They include things that shouldn't be included. And the result is reported free cash flow that dramatically overstates true cash generation. The most common manipulation is with stock-based compensation, which I already discussed. Companies add it back to cash flow calculations because it's non-cash. But as I explained, stock-based compensation is a real economic cost. True free cash flow should account for the dilution it creates. When you properly account for stock-based compensation, many companies reporting strong free cash flow actually have weak or negative real free cash flow available to shareholders. Another manipulation is how companies treat acquisitions. They might report free cash flow from operations while spending billions on acquisitions. They treat acquisition spending as separate from operations, as if buying other companies isn't a necessary part of running the business. But for serial acquirers, acquisition spending is operational. It's how they grow. Excluding it from free cash flow calculations dramatically overstates the cash actually available to shareholders. Companies also play games with working capital. They extend payment terms with suppliers. They collect from customers faster. They reduce inventory. All of this temporarily boosts cash flow, but it's not sustainable. Once you've optimized working capital, you can't keep improving it. So companies report strong free cash flow from working capital improvements. Investors extrapolate that into the future. And then growth disappoints when the one-time benefits run out. The cumulative effect of all these free cash flow distortions is that investors think companies are generating more cash than they really are. They value companies based on inflated free cash flow numbers. They overpay, and they're surprised when actual cash returns to shareholders through dividends and buybacks are far less than free cash flow suggested they should be. The money gets consumed by stock compensation, acquisitions, and unsustainable working capital gains. Now let me talk about a specific area where all these distortions combine into something that genuinely troubles me. Technology companies. particularly unprofitable or barely profitable technology companies with high valuations based on adjusted metrics that exclude most of the real costs of their businesses. I'll describe the pattern without naming specific companies. You can probably identify examples yourself. A technology company grows rapidly. Investors love the growth. The company reports revenue growth of 30, 40, 50% annually. So exciting, transformative, the future, the stock price soars. The company achieves a market value of tens or hundreds of billions. But look closer at the economics. The company grants massive stock compensation, 20, 30, 40% of revenue going to stock grants. They exclude this from adjusted earnings. They tell investors it doesn't matter because it's non-cash. Meanwhile, dilution is eating existing shareholders alive. Ownership percentage is declining year after year, but investors ignore it because they're focused on adjusted metrics. The company makes acquisitions, pays enormous premiums, puts billions of goodwill on the balance sheet, reports earnings as if these acquisitions created value when they destroyed it. Returns on equity look reasonable only because goodwill inflates the equity base. If you remove the goodwill, returns would be terrible. But investors don't make that adjustment. The company reports revenue aggressively, front loads recognition, makes growth look faster than economic reality, reports high gross margins that don't reflect the true cost of service delivery over time. Investors see high margins and fast growth. They extrapolate into the future. They build models showing eventual enormous profitability. But the unit economics don't actually support those projections. The company reports strong free cash flow, but they're adding back massive stock compensation. They're treating acquisition spending as separate from operations. They've temporarily boosted cash through working capital gains. The real free cash flow, properly calculated, is far lower, maybe negative. But investors don't see this because they use the company's reported free cash flow numbers. Put it all together, this company has a market value of $100 billion. Investors think they're buying fast growth, high margins, and strong free cash flow heading toward massive future profitability. But the reality is massive stock compensation, eating shareholders, value-destructive acquisitions, disguised by accounting, aggressive revenue recognition, hiding weak unit economics, and manipulated free cash flow calculations obscuring cash consumption. The real economic value might be a fraction of the market value, maybe a quarter, maybe less. This isn't one company. This is a pattern repeated across dozens of high-flying technology companies, collectively representing hundreds of billions of market value built on accounting distortions, built on adjusted metrics that exclude real costs, built on investor enthusiasm and willingness to believe that this time is different, that traditional metrics don't matter, that growth solves everything, that eventually these companies will be enormously profitable, even though the actual unit economics suggest otherwise. This is the $176 billion accounting problem. Actually, it's far more than that. It's the systematic gap between reported earnings and economic reality across technology and growth companies. The cumulative overvaluation created by investors, accepting adjusted metrics and ignoring the real costs of stock compensation, acquisitions, aggressive revenue recognition, and free cash flow manipulation. The phantom value built on accounting choices rather than economic substance. Why doesn't anybody talk about this? Several reasons. First, it's complicated. Most investors don't understand accounting well enough to see through the distortions. They rely on analysts, and analysts rely on company-provided metrics, adjusted earnings, adjusted free cash flow. The analysts who question these adjustments don't get access to management. They get excluded from information flow. So they go along, they use the metrics companies want them to use. They perpetuate the distortions. Second, it's inconvenient. If you properly accounted for these distortions, if you treated stock compensation as real expense, if you amortized goodwill, if you matched revenue to economic reality, if you calculated true free cash flow, many high-flying companies would look terrible. Their valuations would collapse. Investors would lose money. Fund managers who own these stocks would underperform. Nobody wants this. So everyone quietly agrees to ignore the distortions, to focus on adjusted metrics, to believe that this time is different. Third, it's structural. The incentives all push toward accepting distortions. Company executives want high stock prices. They benefit from compensation tied to stock price, so they present numbers in the most favorable light. They push adjusted metrics. They emphasize growth while downplaying costs. Auditors sign off because the accounting, while misleading, technically complies with GAAP. Investment banks promote the stocks because they earn fees. Analysts support the story because they need access. Investors want to believe because they've already bought. The entire system pushes toward accepting the distortions rather than confronting reality. Fourth, it challenges the dominant narrative. The story of the past decade has been technology transformation, disruption, growth companies revolutionizing industries, traditional business metrics not applying to new business models. This narrative has made people fortunes. Questioning it means questioning everything. Admitting that much of the wealth creation was illusory, built on accounting games, rather than real economic value. That's not a message people want to hear. So they don't hear it. They don't talk about it. They focus on the growth narrative and ignore the accounting reality. So what should investors do? How should you think about this? How do you protect yourself from building portfolios on distorted accounting? Let me give you practical guidance based on how I've approached this throughout my career. First, always fully expense stock-based compensation. Never use adjusted earnings that add it back. When a company reports earnings, go to the cash flow statement. Find the stock-based compensation expense, add it to reported expenses, recalculate earnings. That's the real number. That's what you should value. If this adjustment makes the company unprofitable or barely profitable, that's telling you something important. Listen to what it's telling you. Second, be extremely skeptical of companies with large goodwill balances. Look at the balance sheet. See how much goodwill they're carrying. Ask yourself whether that goodwill represents real value or acquisition overpayments. If a company has made many acquisitions and accumulated massive goodwill, assume most of it represents value destruction. Assume it should be written off. Adjust your valuation accordingly. This will make serial acquirers look far less attractive. Good, most of them are less attractive than they appear. Third, understand the business model deeply enough to evaluate revenue recognition. Don't just accept reported revenue. Understand when value is actually delivered to customers. Understand the ongoing obligations. Understand the true unit economics. If revenue is being front-loaded relative to value delivery, adjust your analysis. Be conservative. Assume the real economics are worse than reported numbers suggest. This skepticism will protect you from overpaying for optical growth. Fourth, calculate your own free cash flow. Don't use company-provided metrics. Start with operating cash flow from the cash flow statement. Subtract capital expenditures. Subtract acquisition spending if the company is a serial acquirer. Subtract the value of stock dilution. What's left is real free cash flow available to shareholders. This number will be far lower than company-reported free cash flow for many businesses. That gap tells you how much the reported numbers are overstating reality. Fifth, focus on companies with simple, transparent accounting. Companies that pay employees primarily in cash rather than stock. Companies that grow organically rather than through acquisitions. Companies with traditional revenue recognition, where you deliver a product and recognize revenue. Companies that don't need pages of adjustments to make earnings look good. These companies are boring. They're not the high flyers. But their reported earnings reflect economic reality. You can value them confidently. You're not building on accounting games. Sixth, be especially careful with unprofitable growth companies. If a company isn't profitable using GAAP accounting, be very skeptical of claims that they're profitable on an adjusted basis. The adjustments are usually excluding things that are real costs. Real economics. If a business can't generate GAAP profits, it might not be a good business. Growth without profitability often means growth that's destroying value rather than creating it. Don't confuse revenue growth with business quality. Seventh, pay attention to capital allocation. How does management use cash? Do they return it to shareholders through dividends and rational buybacks? Or do they make endless acquisitions at high prices? Do they invest rationally in the business, or do they chase growth at any cost? Capital allocation tells you whether management is focused on real economic value creation or on engineering reported metrics. Good capital allocation is one of the best signs of quality management. Poor capital allocation is one of the clearest warning signs. Eighth, be willing to miss apparent opportunities. If you can't understand the accounting, don't invest. If the adjustments seem excessive, walk away. If everyone is excited about a company but the real economics look poor, be comfortable sitting out. You don't have to participate in everything. You don't have to own the high flyers. Being selective, being conservative, being willing to say no, these behaviors protect capital. They prevent catastrophic mistakes. They're more valuable than capturing every opportunity. Let me now address whether this accounting distortion constitutes fraud. Legally, probably not. The accounting generally complies with GAAP. Companies disclose the information, even if it's buried in footnotes. Auditors sign off. The SEC doesn't object. By legal standards, this isn't fraud. It's aggressive but compliant accounting. But is it honest? Does it fairly represent economic reality? Does it serve investors well? No. The accounting systematically overstates profitability. It systematically obscures costs. It systematically creates gaps between reported performance and economic reality. Companies choose to present information in ways they know will mislead investors who don't read footnotes carefully. They know most investors will focus on adjusted metrics. They know most people won't properly account for stock compensation or question acquisition accounting or recalculate free cash flow. They take advantage of this knowledge. Is this fraud in the moral sense? Perhaps. It's certainly not full transparency. It's not honest communication. It's gaming the rules to create favorable appearances while obscuring unfavorable realities. But calling it fraud might be too strong. It's more like aggressive marketing, emphasizing benefits while downplaying costs. Technically truthful while practically misleading. Legal but not entirely ethical. What troubles me most isn't the accounting itself. Rules are rules. Companies will push them to the limit. What troubles me is that the investment community has largely accepted these distortions, has agreed to value companies based on adjusted metrics, has decided that traditional accounting principles don't matter for growth companies. This collective agreement to ignore reality is dangerous. It creates bubbles. It misallocates capital. It rewards companies for financial engineering rather than value creation. We've seen this movie before. In the late 1990s, internet companies convinced investors that traditional metrics didn't matter. Revenue growth was all that mattered. Profitability would come eventually. Investors accepted this, valued companies at absurd multiples. Then reality arrived. Most companies failed. The ones that survived took years to justify their valuations. Enormous wealth was destroyed. Lessons were learned, or so we thought. But here we are again. Different technology, different companies, same pattern. Growth companies convincing investors that traditional metrics don't matter, that adjusted earnings are what matter, that stock compensation isn't a real expense, that revenue growth today is worth more than profitability ever. Investors accepting this, valuing companies at absurd multiples. And the ending? We're living through it now. Reality is arriving. Valuations are correcting. Companies that look profitable on an adjusted basis are revealing they're actually unprofitable or barely profitable when real costs are included. The $176 billion figure I started with is probably conservative. The real amount of phantom value created by accounting distortions across public markets is likely far higher, perhaps over $1 trillion, perhaps more. We won't know the exact figure until the correction is complete, until companies with weak real economics face reckoning, until investors stop accepting adjusted metrics and demand real profitability, until the game of financial engineering gives way to focus on real value creation. That day is coming. It always does. Reality always reasserts itself. Markets can be irrational temporarily. Accounting can obscure truth temporarily, but eventually, always, truth emerges. The companies with real economics survive and thrive. The companies built on accounting games and financial engineering struggle and fail. The investors who understood real economics profit. The investors who accepted distorted accounting lose. Where are we in this cycle? Late stages, I believe. Valuations of many growth companies have already corrected substantially. Reality is being recognized. Investors are becoming more skeptical of adjusted metrics, more demanding of real profitability, more focused on free cash flow that actually flows to shareholders rather than accounting constructs. This is healthy. Painful for people who overpaid, but healthy for markets and capital allocation. My advice is simple. Don't get caught in the next wave down. If you own companies with the distortions I've described, reevaluate them honestly. Calculate real earnings with full stock compensation expense. Calculate real free cash flow. Value them based on economic reality rather than reported metrics. If they still look attractive, fine, hold them. But if the honest accounting reveals poor economics, sell, take your losses, redirect capital toward quality businesses with transparent accounting and real profitability. And going forward, be skeptical, be conservative, demand real profitability using conservative accounting. Avoid companies that require pages of adjustments to look good. Focus on businesses you understand with accounting you trust. These principles work. They've worked throughout my career. They work in all market environments. They protect against accounting games and financial engineering. They focus attention on what matters, real economic value creation, real cash flow to shareholders, real returns over time. The $176 billion accounting problem is real. It's systemic. It's been building for years, and it's starting to unwind. The investors who recognize this, who adjust their approach accordingly, who focus on real economics rather than reported metrics, will protect their capital and find opportunities. The investors who continue accepting distorted accounting, who keep valuing companies based on adjusted metrics, who believe that this time is different, will continue losing money as reality completes its reassertion. That's the truth. That's what nobody wants to talk about. That's the real accounting problem in modern markets. Not a conspiracy, not hidden fraud, but systematic distortion hiding in plain sight, accepted by consensus, enriching companies and investment banks, misleading investors, misallocating capital, creating phantom value that's now evaporating. It's been happening for years. It's unfolding right now. And understanding it is crucial for navigating markets successfully. That's my message. That's what I hope you take seriously. That's what will protect you from the accounting games that have destroyed so much wealth and will destroy much more before this cycle ends.